Hi, my name is Andrew. I'm with IMS Associates, and thank you for joining me today for our Index Universal Life webinar. The webinar should last roughly 30 minutes, and there will be time at the end of the webinar to ask any questions that you may have. So to start, would love to just kind of give a definition of Index Universal Life and a little bit of background on the product and where it is today. So Index Universal Life was introduced to the market in the late 1990s because Index Universal Life is perfect for those consumers that were seeking market participation but did not want to experience any loss risks within the market. The index market has grown from $330 million in sales in 2006 all the way to $1.5 billion in 2012. And Index Universal Life now represents about 30% of total universal life premiums and 12% of all individual life insurance premiums. These index policies allow policyholders to decide the percentages of their funds that they wish to allocate in either a fixed or an indexed account. Now, the real beauty of this product and what we're going to really be harping on throughout this webinar is the fact that the client will never lose money due to a negative market. You know, at the worst case scenario, the client's going to have a 0% gain. The other thing we're going to be talking about is that the gains are compounded, which means if you make 7% one year on your money and 8% the next, it would be 8% on the already existing 7% gain. So that's something we really want to keep in mind. Now, a little bit more about it. The interest options, like I said, could be allocated into a fixed account or to an indexed account. You're really buying these products, though, because you feel like the indexed account is going to be successful. So the majority of the time, people are putting most, if not all, of the funds in the indexed account. The fixed account, however, can typically fall anywhere between 2 and 3% depending on the carrier. The indexed account obviously credits interest that's linked to the performance of one and sometimes several indexes on the market. So you will we'll go over a few of those indexes and also look at an index strategy that's linked directly to our Treasury yield, which is a little bit different. Now, the indexed account examples, these are really microcosms of the full portfolio of the index product and of the index products out on the market. And you know, there's a lot more options to diversify than these ones that we're going over right now. You know, certain groups of people, certain ethnicities really like, you know, putting their money in certain places. Obviously, the Hang Seng really appeals to the Asian market, and it's something that, you know, they've had a lot of success with in terms of that demographic. Now, to get into this, the S&P 500, founded in '57, focuses on the 500 leading companies in the United States. Basically, it represents 70% of the total U.S. equity market. Over the past 20 years, the performance of this index was 7.55%. Next one we'll look at is the Euro Stoxx 50. That was founded relatively recently in 1998 by Deutsche Börse and Six Group. That covers 50 European stocks, and over the past 20 years, their performance a little bit higher at 8.89%. The next one we will look at is Hang Seng. It's founded in '69. There's 49 stocks in total in this. Over the past 20 years, the performance of this was almost 42%, but you know, that is not an accurate number. This is really due to huge rates in the 90s and early 2000s when they were really seeing a lot of growth. The rates have since come back down to earth and are typically falling in line with, you know, how the rest of the indexes like the Euro and the S&P are typically performing. The last one we'll talk about right now is the Treasury yield. This is the return on investment on the debt obligations of the U.S. government. They're considered very easy to predict and have very low risk. Over the past 20 years, the performance of this was 4.78%. We have, seen this increase as of late, and we really, think that this is something that's going to be pretty easy to predict, and people think it's going to, kind of keep ticking up slowly. The next thing we're going to want to talk about, and this is really, a big part of why we're doing this webinar, is the tax and loan advantages of the index products. So these index universal life products can create tax-deferred growth and can create tax-efficient distribution. So the nice thing about this is the index universal life policies grow tax-deferred, and compared to IRAs, for instance, cash values can be accessed without any type of tax penalties at any age. Whereas an IRA, you can't touch it until you're at least 59.5 years old, or you're going to get some tax ramifications. The other thing to keep in mind, if anything was to happen to the client, if they were to die prematurely, this is still an insurance product. It's still going to self-complete. It's still going to give that critical lump sum, tax-free, obviously, right to the beneficiaries. Really, the nice part is if the IUL policy is managed strategically and kept in force, its buildup of death benefits proceeds plus the cash value that you can access, they may all fall under the never taxed column, where you never taxed on any of these funds that are within this index universal life. And, the next point would be, these loans and withdrawals are not taxed as long as the policy is in force and it's not a MEC, a modified endowment contract. Go ahead and reach out to me if you do not know what a MEC is. Be happy to go over it with you. So the other thing we're going to really harp on is the IUL owners and the beneficiaries. They're never going to lose money due to a down market. So as an example, mutual funds provide no such guarantee, and obviously they don't provide any sort of death benefit of any kind. Now we're going to dive a little bit deeper right now into the tax-deferred growth of the index universal life products. So the index universal life account, like we've been saying, is going to grow tax-deferred similar to an IRA or a 401k, whereas, most alternatives, such as a mutual fund or a brokerage account, do not grow tax-deferred. And the nice thing is, about this tax-deferred growth, like we've talked about, you're going to earn interest on your principal. You're also going to earn interest on your interest. And you're going to earn interest on the money you would have otherwise have paid in taxes on the interest in those other alternatives that we had just mentioned as the mutual fund or the brokerage account. And, investment choices typically are limited to mutual funds and in mutual funds, whereas your account value, where your account value is, subject to market volatility, market risk, and that's just something you're avoiding with the index universal life policy. Here in California, we've got a combined state and federal tax rate on capital gains of 33%. It's the second highest in the world behind France, I believe. This does not include any broker fees as well that you'd end up paying on these those other deals. With an index universal life, you don't pay taxes or fees on the gains that the policy incurs. No broker fees for your client. The other nice thing, there's no limitations on the amount that can be contributed to an index universal life policy. With an IRA, you're going to be limited, depending on your age, of $5,000 or $6,000 annually. And, that's really put a lot of people that have that extra income, have that money lying around, they don't have anywhere else to put it. Index universal life product is really going to be a good idea for those type of clients. Now we'll dive a little bit more now into the withdrawal section of these products. What you're going to see is there's going to be tax-free withdrawals. These policy owners, they're going to be able to access the money without any sort of penalty, regardless of age. Obviously, going back to the, the IRAs, prior to age 59.5, they're going to get a 10% penalty. In addition, they're also going to be taxed as income for the year in which the withdrawal is taken. So that's going to go on your tax return. You're going to have to put that down as additional income. That is not the case with Index Universal Life. They grow tax deferred, and they're never taxed as long as they're in the form of a loan or a withdrawal, and that it is not a MEC. So, it really allows the owners to control precisely if and when and how much money, will be taxable depending on their needs and their circumstances. So, they're pretty easy to position so that at the owner's death, the beneficiary is not subject to either income tax or estate tax with what they get from the product. Now, next thing we're going to want to talk about, which is an important part of Index Universal Life, are the caps and floors of the product. So Index Universal Life products have certain caps, and what the cap is it's the maximum percentage of indexed interest that your cash value can possibly earn. So the cap is sometimes on a monthly or an annual basis, depending on what crediting method was chosen. So these caps, it's the max amount of interest that you can possibly make if your index does well. Now, on the flip side, they also have floors, and the floor is the minimum annual interest rate your policy will be guaranteed for a given year. And, the floors are part of the nice part about the index products, These rates tend to be anywhere between 0 and 1%, but what that means is you're never losing any money. Worst case scenario, you just didn't see any growth that year. You just didn't see any growth that month. So if your policy's hitting its cap, that means it's doing really well. If the policy's hitting its floor, it's obviously not performing as well that year, but keep in mind there's no loss in your money, and you know what? Chances are if the market's doing negatively and you've hit your floor, everyone around you that has money in the market is losing money while your account's just sitting there pretty, at 0% gain. Product we're going to be looking at first, we're going to look at 3 different examples of an Index Universal Life product. So first one we'll look at is by Minnesota Life. They were really in the market right off the bat with these index products, and I've kind of led the way, and really this is a flagship product for the index market and a good place to start when kind of learning about the index market. Flexible premium with a focus on accumulation. You're going to see that in all of the index products, and that flexible premium is nice. It works just similar to a regular Universal Life product. And with this Minnesota Life product, you're going to have 5 index choices. 3 of them deal directly with the S&P 500, so pretty easy to explain to your clients. 1 deals with the Euro stocks, and 1 is a hybrid blend of both of them. The fixed account on this one is guaranteed to be never less than 3% annually. Now, this product illustrates at 8.1% based on a 30-year look back at the S&P. So 8.1 may be illustrating a little bit high on this one. You're able to adjust that rate to a rate you feel more comfortable with. So that's also an option with this product. And the product's got a decent cap on it of 13% and that 0% floor as well. Now we'll look at a case example. We'll do a 35-year-old male. We're going to do a 35-year-old male for all of these case examples just to keep it apples to apples. In this case, he wants to plan for retirement. He wants to make sure as well that, when something happens in the event of his death before retirement, that his beneficiaries, his children, are going to be able to get a pretty substantial death benefit. He wants to keep it simple, use the option A for the index, puts 100% towards the S&P 500. With this, we're solving for the premium, and we're going to solve with a minimum face amount, and that's going to basically be able to maximize the amount of cash value we get with the money that we're putting in there. The client also wants to stop paying at age 65 and just start taking withdrawals at that point. He also wants to spend about $12,000 annually. So let's see an example of the illustrations here. You pull it up. All right. So we can see 12,000 here. Another nice thing that works here with these illustrations is what we've seen to work is you choose the minimum death benefit, but then you do an increasing death benefit option so that it's able to increase all the way up into the point of withdrawals. At that point, you switch it back to a level death benefit, and that really kind of maximizes what we're really trying to accomplish here with this. So you can see 12,000 going into the product going in as premium every year. You got your guaranteed values here and your non-guaranteeds here on the right. You know, keep in mind when we're selling these products, we're really selling it on the non-guaranteed side. The guarantees are nice, and obviously, you know, the client's going to want some level of guarantees on the product, but if someone's buying this, they're buying it for the theoretical accumulation that can happen with these products. So in this case, at age 65, we wanted to start taking money out. We're able to take 15,000 out all the way from age 65, and that is guaranteed until age 82. Now that is, you know, that's really kind of the safe illustration. You know, this would be kind of how you would want to illustrate it and show someone, hey, you're going to be able to supplement that retirement, get 15,000 a year, guaranteed to age 82. If anything happens, you know, you're going to get a pretty decent death benefit guaranteed here to your beneficiaries. Now on the flip side, the other one I wanted to show you, pull this up, would be here. So we've got same thing, same setup, except in this case we have decided to take the maximum amount of benefit. So at age 65, he's going to be able to get $100,000 roughly a year to get almost $400,000 in the first 4 years. Now at that point, it's going to lapse. That is assuming, you know, we haven't had a real strong showing in the market. The index account isn't doing as well as we thought, and you know it's at 3%. So you probably wouldn't want to illustrate this for any of your clients, but at the same time, you know, I just wanted to show you the other end of the spectrum, and you can kind of see the maximum amount of money that we'd be able to get out on these type of deals, which obviously is pretty substantial to get almost $100,000 a year. Next product we're going to look at is by ING. They are pretty popular in the index market. They have really focused their index products on the whole idea of it being a global product. What they've done is they use 3 different indexes. They're using the S&P, the Hang Seng, and the Euro stocks, and they're able to choose the best 2 performing stocks and use those indexes towards your policy. So if the Euro stock does the best, S&P does second best, the Hang Seng didn't do so well, 75% goes towards the Euro stocks, 25% is going to the S&P. Hang Seng gets nothing, and we just drop it off. So that's their way to kind of maximize their index interest. Nice thing about this, currently there's no cap on it, which means if these indexes do really well, you know, the interest is skyrocketing, it's up at 25%, hey, your client's going to be able to see all of that. And, you know, that's a big sticking point on these products, because at the same time he's going to be able to see all of that, and he's not going to see any of the downside if it goes south on him. You know, they've got a floor on this product of 1%. So, you know, worst case scenario, he's still going to get that 1%. Now, for this case example, I wanted to show a 35-year-old male, got a 3-year-old daughter. You know, this product appealed to him because he kind of considers himself pretty market savvy, likes the idea that his money would be indexed in 3 different accounts throughout the world. He's come to the conclusion he wants to only spend about $6,000 a year into the policy. He wants to be able to take from the cash value in 15 years in order to pay for the college expenses, or, you know, put it towards the tuition. So what we're going to do is we're going to, you know, do that minimum death benefit, $6,000 annual premium, and we're going to start pulling money out on the 15th year to the 18th year to coincide with his daughter's tuition schedule. So let me go ahead and pull that up right now. So the first one we're going to look at here is the $6,000 going into it. You got the guaranteed side here, obviously the non-guaranteed right here. Similar to the Minnesota Life product, I wanted to kind of keep the guarantees in play so that, you know, that if anything was to happen after the disbursements come out, you know, he's going to be able to decide, hey, do I want to still keep putting $6,000 in? Do I want to keep this insurance in force, or am I happy? You know, the kid's gone to college. I don't need the insurance anymore. I was able to pull about, you know, $40,000 towards her tuition. It's really going to come down to what the client is looking for. So on the flip side of that, you're going to see here, this would be, you know, assuming the index, obviously, we're assuming this index is going to do well. He's going to be able to pull $35,000 out a year. And, you know, obviously, if we don't see the index perform well, this thing's going to lapse pretty much after the first year. But wanted to show, you know, anywhere between, it's probably going to fall somewhere in between the 15 and this 35,000 that he's going to be able to pull out for the tuition. So wanted to show the other side of it as well. Nice thing about these ING illustrations as we scroll up, they've got some great just kind of graphs and forms, and really just try to be as informative as they can on the product. They're showing 5-year period, 10-year period, 20-year period, kind of showing how the products typically, you know, what type of indexes we're going to see, you know, 90% of the time, 80% of the time, et cetera. So definitely a good thing to look at when you're illustrating these products. The next one we're going to look at is the Lincoln product. Now, this is the one that's going to be tied to the Treasury index. This product's unique in that it's tied to the Treasury yield. It's got some built-in guarantees, which are nice. You know, the first 5 years of the policy, they're going to guarantee you at 4%. And, you know, you're like the other indexes, you're going to be able to borrow some cash from the policy as long as it's in force. And, you know, there's a guarantee of 2% that's not tied to the Treasury yield. That would be, you know, their version of the fixed account. So little graph here, you can kind of see what the Treasury yield has done in years past, 10-year, 20-year, 30-year, 40-year, 50-year look-backs. Obviously, hasn't been the best as of late, but it's really, you know, it's ticking back up. I think economists think it's going to continue to tick back up, and that's really why Lincoln thought it was such a good time to launch this type of product. Now, going back to our case example, here we go, 35-year-old male again. In this case, though, this guy's pretty risk adverse. Doesn't like the idea of having his premiums, you know, even tied to the stock market, European or, you know, the Hang Seng or even the S&P. He likes the idea of the Treasury yield, though, because it's much more predictable and much more accessible. And, you know, he's still going to get that option of getting some of those preferred interest rates through an index. He is mostly focused on having $1 million of guaranteed death benefit, and he needs it to go to age 100. So let's see what that illustration looks like. Can we pull it up? So here we can see he's putting $7,635 in to get that $1 million death benefit. You can see there's going to be some pretty decent guaranteed cash building up in the policy. You know, we're going back to that, you know, we're really selling these on the non-guaranteed side. This thing only illustrated at 4.5% for the non-guaranteed side, what we think the Treasury yield's going to be. So there's going to be some pretty significant cash options here, as you can see, when he kind of gets into his retirement age, theoretically. And you can also see on that guaranteed side, that $1 million is going all the way to age 100, and that's guaranteed as long as that premium's paid. So not as many moving parts in this product. I would, you know, consider it maybe more of an easier sell to your clients that are looking for this type of product. So, you know, it's something to look at if you've got someone that's pretty risk adverse and isn't really open to having their money in any way, kind of with the stocks. Now, to kind of tie it in, we're really going to look at now is the Index Universal Life Key Points. One thing we really want to harp on, been harping on this entire webinar is the excellent tax-free cash value growth. It's going to compound. The interest is compounded, and you're still going to have the benefits of the death benefit if anything was to happen. You know, the cash value is going to accumulate on positive changes in the market, and it's not going to be affected by a negative market performance. You're not going to lose money if the market goes down the tubes. You can adjust the premiums on the fly. If you've got some cash value in there, hey, we can start using that towards premiums if need be. And the tax-free access to the cash doesn't matter how long it's been in there, doesn't matter of your age. You're going to be able to take this money out tax-free. You're going to be able to supplement it for your retirement, complement a college funding strategy, use it for an emergency, any sort of debts that occur. And really, as an agent, the great part about these products is that it's going to position you not to only be a life agent, but to really be looked at almost as a financial advisor now. And hopefully that's going to open some doors for some more business opportunities, you know, within these clients. You're not going to be, you know, just an order taker. I know we're used to doing those term life insurance products, and it's pretty black and white. This is going to show some savvy. It's going to really, you know, hopefully put you in a different light with these clients and get some more opportunities for business. And the bottom line is the market's headed this way. You got to be, you know, it's best to be in front of the competition, be knowledgeable about the products, and, you know, don't be left in the dark when a client comes to you and starts asking about it. So, you know, those are the real key points we want to focus on. Hope you enjoyed the webinar. Again, my name is Andrew. Here's my information. My email address is here. That's my direct phone line to my desk. Please call me if you have any questions about any of the information you saw in this webinar, and thanks again for joining me.